everyone, and welcome to another episode of the vAuto podcast. I'm Lance Helgeson with vAuto, and I'll be your host for today's conversation. Our goal with this episode is to bring some clarity and focus on current and emerging market conditions in used vehicles and the operational implications they create for dealers as we move through the last half of 2022. A couple weeks ago, I was part of a vAuto marketing team meeting where my guest for this episode shared what I considered a sharp and thorough rundown of the market factors that would create opportunity and risk for dealers. The presenter was Mark Strand, Senior Director of Economic and Industry Insights for Cox Automotive. I thought the data that he has in hand and how he thinks about it would be fertile ground for today's podcast conversation. So Mark, welcome to the podcast and thank you for taking time for us.
Thank you, Lance. Happy to be here. My pleasure.
Great. Well, Mark, just to always level set in a bit here with our listeners and make sure that they know you just a little bit more than the name I just shared, tell us about the work you do for Cox Automotive and your background, please.
Sure. Again, my pleasure. I'm on the Economic and Industry Insights team that supports our chief economist, Jonathan Smoke. The essence of what we do every day is to try to use data to read the tea leaves on the direction of the industry, really. We try to take a holistic view and synthesize into a coherent story, all the data points we can get our hands on that we can track: macro indicators, demographics, consumer sentiment, retail demand, vehicle valuations, everything. And
Yep.
We try to do that for local markets where we can, although the data can be thinner. But, we live the big data mantra, And for my background, I've been in the automotive space for over 15 years. I started the journey with NADA as a market analyst and later economist. From there, I spent a few years with R.L. Polk, working on OEM accounts, supplying registration and loyalty data, the data they use for their strategic marketing decisions and managing their dealer networks and understanding local market dynamics. So I've seen the industry from multiple angles, encompassing, both the dealer and OEM perspectives, really, spending all of our days trying to get our hands on the best data and get as local and near real time as possible.
Excellent. Sounds like a varied background that's typical for a lot of us that work at Cox Automotive. And I think probably like me, you're happy to be in the car business these days.
Yep.
Well, speaking of the data, Mark, let's start with a look at used vehicle values in the wholesale market. Now, I've understood that we have seen some depreciation and it's a little bit more normal looking overall, but perhaps values in some segments are stable and in others they aren't. And even more recently, it seemed like I was reading that the values have risen a bit. And so I guess, can you speak to what's happening with values and depreciation and some of the segment sensitivity that might be going on?
Sure, and that is correct. And what we're seeing in the latest data is that in the last few weeks we have been kind of in an inflection point in the market. We're getting. I hesitate to use the term normal because we're still not out of kind of an abnormal period of history, and particularly in the auto market, but becoming more normalized with some depreciation happening in the back half of the year after the spring selling season. We're really kind of more at an inflection point where used vehicles have returned to becoming a depreciating asset. There's some level of equilibrium between supply and demand out there. I would add, though, that tight supply is going to persist for years, and we really have reached kind of a step change in vehicle values. Right, we're at a higher level that's going to persist for a while, but we're starting to see the return that within that context, you're going to see more normal depreciation patterns throughout the year, and we've definitely seen that in recent weeks. More recently, we've seen wholesale values softening, maybe even a little more than you would usually see at this time of year, but we think that's generally temporary. I mean, there's two main factors that we've seen impacting values over the last month or so. One of the factors is that, due to the supply situation on the new car side, rental car companies have had to kind of periodically dip into the used market to supplement their fleets.
Yep.
And that has had a big impact to the upside, kind of driving vehicle values up more than usual because they've been paying premium prices, right? But as of June, they kind of stepped back and have not been buying so far. So that's kind of one pressure point that was removed from the market. And the other thing we think is that, at this juncture with rising interest rates and the inflation narrative out there impacting consumers, we think overall dealers have hedged a little bit and are stepping back a bit and trying to assess, the overall impact. So they're kind of trimming their inventory and scaling back buying a little bit to kind of digest where they are and what that second half of 2022 is going to look like, and what that means for segment. So segment or body style perspectives.
Yeah.
I mean, what we're seeing is that, while values overall are a little softer, it's the more affordable basic transportation like sedans and compact CUVs that are outperforming, maybe depreciating less, or in some cases gaining a little bit, right? Which is what you might expect with the affordability pressures coming at the average household out there right now, the average used car buying household from multiple fronts. We're seeing, where the relative softness is, and I say relative, right? The relative softness is in pickups and full-size SUVs right now, which when you think about the dynamics out there, those are right now the costliest vehicles, both in terms of price and daily operation for the average used vehicle household, right? So we're definitely seeing more interest in those entry-level basic transportation options. One last thing I will point out on segment is that vans are doing particularly well in relative terms and outperforming the overall market most on valuations. And that's really been a feature of the entire pandemic period, with the proliferation of delivery services out there. And van manufacturing has been impacted by the same supply constraints as all other body styles. So, with that increased trend towards more vans needed for delivery service, they've really been in great demand. So if you can be lucky enough to get your hands on some van inventory, you've got plenty of outlets out there to turn a profit. And
does that van definition extend to minivans like the Odyssey that's parked in my driveway?
It does. I mean, that's not so. I mean, I could see some people maybe trying to repurpose a minivan if they're kind of contracting to, if they're doing DoorDash or something like that, because it's got dual purpose in the family. But one other kind of broader macro trend we've seen since 2020 is that, millennials are starting to turn 40, right? The oldest millennials turned 40 in 2021. They may be starting households a little later than prior generations, but we've seen kind of a surge in demand for minivans because they're getting to that phase of moving to the suburbs and starting families. So that has been a tailwind to minivans as well.
Well, Mark, I want to go back to 2 points that you raised there before I ask a fresh question. The first of which is related to depreciation. I'm wondering if we can quantify what that might be in terms of percentages here for our listeners.
Sure. Well, we're looking at this by week. In the last week, most recent week for which we have data, I mean, it was close to a 1%, a little less, but around 0.8, 8 percentage points, 0.8%, week over week. And looking at the last 3 weeks, most of July, when we talked about kind of the lack of that pressure from rental car companies buying, in cumulative, it's about 2% down over the last 3 weeks.
Okay, thank you. And then the second question was, you mentioned that the dealers may be hedging a little bit, trimming inventory and scaling some of their acquisitions back a touch. And I'm just reminded, I believe the average days supply on dealer lots runs about 50 days. So if that's what they're doing, that would seem to make good sense in this current moment.
Yeah, and leaving out the dynamics of supply that had been impacted by the pandemic. I mean, typically going back to 2019, used car dealers keep about 45 days. So if we're running a little ahead of that, closer to 50, it makes sense that with all the other uncertainty out there in the market that we think dealers are just kind of pulling back a little bit to assess where things are going.
Very good. Now, we just talked about wholesale values. Let's look at the current state of retail prices and sales volume. I understand that generally speaking, what happens in the wholesale market translates into the retail market. So what might we be seeing there in terms of changes to pricing and perhaps any sensitivity that's segment specific?
I think great question again. And I think the story is relatively consistent on the retail side. We do see that lag. It's typically about a 5-week lag before what we see happening at wholesale translates into retail price trends. But right now, prices are firm and stable on the retail side. Sales momentum, volume momentum, is also actually, when we look at the last couple of weeks, seems to be picking up a little bit. The volumes are down overall a bit compared to 2021 with, those higher costs out there and more financial pressure on used car households. We're still seeing firm prices hold up, and when we look at the retail market overall this year, we didn't see as pronounced a spring bump because of delays with tax refunds, right? The disbursement of tax refund checks was very gradual and stretched out over a longer period this year. So that really had the impact of spreading out the spring season. And, some of that demand with uncertainty out there is probably persisting into mid-year. And, it's made the sales trend a little flatter than we would normally see. But when you look at year-to-date June, it kind of adds up in the end, right? And with that, when you think about from a segment perspective where it's going, we're seeing kind of the same trends at retail, right? It's the demand is most intense for those affordable entry-level vehicles that are actually in shortest supply out there. But when you look at that gap or the margin between where wholesale is right now, maybe softening a little bit, there's some buying opportunities out there. We're still seeing firmness on the retail side. So there is still an opportunity out there, and we think there's going to be a window here for dealers to turn a healthy profit for the next several weeks at least before we start to see maybe some of that softening in the wholesale price catch up on the retail side.
Okay, but perhaps it's already there a bit. That's retail softening when we're talking SUVs and trucks.
Yes, and that we're attributing that mostly to that affordability story, right? The increase in fuel prices, although that's starting to moderate now, and we hope it moderates further. But when you look at the run up in prices, again, those are the most expensive, costliest to operate vehicles, and with the rapidity which inflation has taken hold, I think that's caused a lot of consumers to kind of back off and look for those more affordable vehicles. The problem there is, and the reason those more compact and affordable vehicles are performing so well is, that's where the tightest supply is. When you go back pre-COVID, consumer taste kind of shifted in favor of utilities and pickups, right? Those vehicles, when you compare it to what happened in 2008, even the large vehicles today are much lighter. They use 6 cylinders, use more turbos. They're more fuel efficient than they've ever been. And the consumer likes the experience, likes the room and the utility. Yeah. So preferences shifted that way. The Detroit OEMs basically abandoned sedans. That really left only kind of, Toyota, Honda, and the Asian suppliers. And those are the OEMs right now having the most severe supply challenges. So in the pipeline, we had limited supply of sedans, and we're not catching up on production right now. So that's the tightest part of the market.
Well, I know that makes it for a perfect segue, Mark, because I wanted to ask a bit about CPO units, because we have seen, over the last 5-7 years for sure, that CPO has been an especially strong part of the used vehicle inventory portfolio of franchise dealers. And I've also understood that some manufacturers have extended the model years that are eligible. So 5 and 7-year-old cars can be a CPO unit. But I also know, just as we've talked, that uh, that's the supplies of those are going have been and will remain constrained. So I'm curious what you're seeing there in terms of supply and demand for CPO eligible vehicles and perhaps market dynamics that are related to those moving forward.
Yep, no, that's a great and very pertinent question. You're right about the popularity of CPO vehicles. The outlook for supply on, I'll use the term nearly new as that CPO profile vehicle. I mean, that's going to remain challenged for the foreseeable future. And when you think about the supply dynamics, really we have to wait until the point that new vehicle production constraints are removed and leasing returns to normal levels before we can really even start the clock on the countdown to when we will see materially improved supply of these 1 to 3 year old vehicles in the used market. At this juncture, as we sit here this morning, as we all know, due to the lack of new vehicle supply, right, sales this year are capped at what looks like about 14 million units, give or take, maybe a little more to the upside on that if production improves backside of this year. But on top of that overall volume constraint, leasing, which is the primary source for these CPO profile units, is way down this year and last year, right? Prior to the supply crisis, lease penetration was close to 30%, on 16 million units. So almost 1 in 3 new vehicles sold was a lease, and that gave you a steady supply into the CPO market. But right now, lease penetration is closer to 20%, or 1 in 5 of the more limited volumes we're selling. And that's mainly because with tight supply and low incentive spend, OEMs just don't have to subvent leases or make, or spend money to incentivize lease offers. They can sell everything they have, and the value proposition right now to the consumer is to purchase rather than lease. So with that reality, the path back to what we would call normality with supply of nearly new vehicles doesn't begin until we get new vehicle production back to a level that supports an annual sales rate around 16 million units, and then when lease penetration gets back close to 30%. So for that to translate to materially improved supply of younger used vehicles, we're still talking about a time frame of years. So that's going to continue to be a super hyper competitive part of the market out there. And to the second part of the question on the dynamics of extending CPO to older vehicles, I think that obviously makes things a little tougher on the independent dealer space, right? We all know certain brands are known for durability and longevity, and the older vehicles from these brands will run reliably at a relatively low maintenance cost, well past 100,000 miles, or say 8 years of age. And traditionally, franchise dealers have mostly kind of passed on these older units, and they end up being more the bread and butter of independent dealer inventory, right? So in this supply constrained market that we're going to continue to see with OEM support, on CPO certification for these older units, franchise dealers are going to be incentivized to keep and retail more. So the bottom line is going to be that it changes the value perception on those 8-year-old vehicles. They're going to become more sought after, and the acquisition cost is going to go up, and that's just going to make things a little tougher on that independent dealer space, I think.
Very good. And you just touched on acquisition. So let's spend a minute on how dealers are acquiring inventory, Mark. And I've been struck just by how much dealers have shifted from pretty much relying on auctions and trade-ins to plumbing whatever channel they can find cars. And at the same time, if they're going to auction, it seems like there's been a pretty seismic sort of shift to digital purchases rather than in lane. So I'm wondering if you could just give us a little color on recent auction activity in lane and online, and perhaps how we're thinking that will look, in the months ahead.
Well, I like your comment on the shift to more direct acquisition because being in the industry, I pay attention to that, and I notice anecdotally, personally, I get solicitations via email like almost daily to buy my vehicle, whether it's from a dealer I've done business with in the past, or Carvana or CarMax. Someone's got a marketing list out there, and I think in the future OEMs might do this more, but basically I think they've got a list of VINs in operation right now, and they're finding ways to tie those VINs to email addresses and owners, and they're just going direct to customer and blasting you with email in hopes that you'll get into their buying queue. So I think that's something that's going to persist, but more with the traditional auctions and the shift to digital, high level, there's definitely been a shift to more comfort with digital acquisition channels that was catalyzed by the pandemic. The last data I looked at in 2019, it was about 20% of wholesale volume that was transacting digital only, or you can call it upstream or offsite, whatever you want to call it. That has increased steadily throughout the pandemic, and I think it's going up every quarter. I think it's about 35% of units right now we're seeing that are going digital only. If you add in simulcast and in-lane or on-site units that have a digital element to the transaction, the share of vehicles transacting that way has gone from about 50% in 2019 to the 75 to 80% range right now. And when you think about how dealers operate, it could go higher, but we expect that level of it to stick. The question to me will be, hopefully going forward, as COVID risk is lessening, dealers always like to go to the auctions and kind of experience the inventory in person if they can. It's a social opportunity, ear to ground in the local market. So I think maybe we'll see a little bit of a plateau, but it's not going back. I think that the dealers have gotten that taste of the ease. The trust has grown. There's a lot of assurances now, and money back guarantees that come from the auctions themselves. So I think we've definitely had a step change in how, at least at the auction, vehicles are going to transact.
Excellent. A final question, Mark, and we've covered a lot of ground here in the past few minutes, and I'm just wondering, our audience is primarily dealers, managers, and others that work in dealerships. So if you were to put on the hat of a used vehicle manager right now, based on everything that you see in front of you, what would you set as maybe your top 2 or 3 operational priorities here for the back half of 2022?
Well, that is a great question, and there's a lot of directions you can go to call out ways to get, more efficient and profitable with some of the challenges and uncertainty out there. But when I think about, so I'm putting the hat on, my biases, I've got one particular direction to go with that, and I would say the number one thing is I would be prepared, currently and going forward in 2022 to kind of be in position to use any demand signal data I have at my disposal to understand in as near real time as possible how demand and behavior of the local used car buyer in my market is changing or adapting, right, in response to the market challenges out there. And that's inflation, that's rising interest rates, these things that are squeezing the budget of the average used car buying household more than say the high income new car buyer. And that's going to have different impacts in different markets. Not all markets, not the backyard of every dealer is not the same as the backyard of another dealer, right? So how do you stay on top of that, right? And when we think about it, in many ways we're living through an economic, financial, behavioral experiment in real time here. We've got this 40-year high levels of inflation. We've got this pressure on the consumer out there, and the strategy of the Fed is to raise interest rates to try to, align demand with supply and bring inflation down, right? And that pressures that used car buyer. And we're already in a market where before we got into the inflation problem, supply and choice were already constrained, right? It was hard to find the vehicle that you wanted. So this is just piling on. So from the dealer perspective, I would think about ways to work with your vendor representatives, your performance managers, things like that, to really regularly access and scrutinize any real-time demand signal data you have available, and see if you can see how your customers are reacting and changing their behavior. And to me, this would include, your website data, inventory engagement metrics, the kind of leads you're getting, who's coming into your store, are they leaving frustrated, what kind of vehicles are they looking for, and compare what's happening now and compare what's happening as we go through this period to what your customers were doing last year and in 2020, right? What kind of vehicles are getting the most engagement, at what price points and body styles, and really be prepared to use that data to guide your inventory mix and optimization to try and stay in step with the consumer as they adjust to all this.
Wonderful. That's a great answer. And it speaks straight up to the kind of the fundamentals that maybe when things were so much in a go-go mode the past 2 years, no one really had to think about.
Yep.
Well, Mark, thank you very much for taking time for us for this podcast. We appreciate your perspective and the insights you brought for us.
Excellent. My pleasure to be here, and thank you.
And everyone listening, thank you for joining this episode of the vAuto podcast. Until next time, stay well.